All right, hello everybody and welcome. My name is Lee Schwartz and I'd like to welcome you to our webinar. Our topic today is latest updates on stimulus legislation tax credits and PPP loans. So before we get started, I just want to take a sec and say a few words about SVA. For those of you not familiar with us, we were founded 47 years ago, which means we're just about halfway to our goal of being a 100-year firm. Our vision is to remain independent. So while a lot of other regional firms look to consolidate or merge with larger firms, our goal is to continue serving the same clients that we have since 1974, and that's nonprofits and closely held businesses. So with that in mind, we've really strived to provide more information and assistance over the last 10 months than anyone else. We've conducted 34 webinars and we've had over 5,000 attendees, maybe close to 6,000 after today. When the first PPP loan program was launched, we provided guidance not just to our clients, but to anyone with questions, because the stronger your businesses are, the stronger SVA is. And we've got a bunch of events coming up that I'll tell you about at the end. And we are going to try and leave a few minutes at the end for questions. If you have one, open up the chat box in Zoom and submit it there. We've also received a few ahead of time, so we'll have a lot to answer, I'm sure. If you're a client and your question doesn't get answered, we'd encourage you to reach out to either your SVA contact or our presenters today. If you're not a client and you have questions, please reach out to me and I will get you connected to a subject matter expert who can get those questions answered. And I'll just say, over the last 10 months or so, we've found that there are just a ton of businesses that aren't getting timely or knowledgeable advice from their CPAs and advisors. And we're happy to step in and help. So please share this information and our contact details with others. Now let me introduce our speakers. If you've attended any of our PPP webinars before, you're already familiar with Nancy, Dan, and Eric. But for you first timers, Nancy Melberg is a principal with SVA and leads our Management Advisory Services group. Dan Glomsky is a CPA and principal and leads our valuation practice. And Eric Trost is a CPA and is one of the leaders of our tax practice. So you've got the right three people on. I will be back for the Q&A, but Nancy, I'm going to let you take it from here.
Thanks, Lee, and good afternoon, everyone. And thank you for joining us to what I like to refer to as my PPP book club. And I have to say, 2021, new year, new PPP. So we got a lot of information to cover. And so I'm going to take this first section and talk about this new loan. So I'm sure a lot of you have heard about this second round of PPP funding that's available. So I want to talk a little bit about some of the hot topics around it, the eligibility, and I'm going to point out where there's changes from the first PPP to this second round. So the first one, let's dive into the eligibility. So if many of you remember, the first round of PPP was 500 or fewer employees. This round is 300 or fewer employees. So I think what they're trying to accomplish in this next round is maybe get to some of the smaller companies who either didn't receive funding the first time and I know they didn't run out of money, but I think they're trying to reach maybe this smaller client. So one of the big requirements here in this new loan is a 25% reduction in revenue in any quarter in 2020. And you're going to compare that to the same quarter in 2019. So if you're looking at quarter two, you're going to look at the quarter two 2020 and compare it to quarter one 2019. And you have to show a 25% reduction in revenue in that quarter. Now you can pick any quarter in 2020 to compare to 2019, and you can also take the entire year. So if you compare the entire year of 2020 to 2019 and you have a 25% reduction, then you're going to qualify for the new PPP loan. So what exactly is revenue? We've been getting a lot of questions around that. So revenue does include all of your sources of income, interest, dividend, rent, royalty, commissions. What it does not include is it does not include the revenue or the, I guess we really didn't call it revenue, but the funding from the first PPP. So if you got $100,000 in the first round of PPP, you are not going to include that when you're counting your revenue in 2020. So make sure you keep that in mind. It does not include that. One of the other criteria for eligibility is that you have to have used the full amount of your first PPP loan. Now, I want to just explain something a little bit here. And if you received too much funding in the first round and some of those expenses did not qualify, I do not think, and again, this is maybe my opinion, so if anyone has another opinion, maybe Eric or Dan jump in. But if you received too much, because I think as everyone knew, the rules were changing in the first round of PPP, and so perhaps some people didn't limit shareholder wages to that $20,833. And so they might have received too much money. So I think this is, have you used all of the money that you were entitled to? I do not think it necessarily means if you still have a small balance on that loan that you cannot apply for this first loan. So some of the other things, loan amount pretty much stays the same for most people. It's 2.5 times the average monthly payroll costs. And you can actually use the average monthly payroll cost for 2019 or for 2020. If you actually look at the bill, it says the previous 12 months, but because we're in January, they're just saying use 2020. Even if somebody doesn't apply until February, you don't have to take January and then take 11 months back. So you're going to use your average monthly payroll for 2019 or 2020. And then you're going to take 2.5 times that unless you are a business that your NAICS code starts with 72, which is going to be really a lot of the restaurants, hotels, hospitality industries, because obviously those industries were hit the hardest by COVID. So those industries are going to be allowed to use 3.5 times their average monthly payroll. So again, calculation very similar to the first round. You're going to use, in some cases, the exact same numbers. However, the one thing that I do want to add to this is the monthly payroll costs in this round. If many of you remember, the first round included group health insurance. This also includes life, disability, dental. So I am seeing for some clients, even though we're using 2019 numbers because we can add life, dental, disability insurance to this, that number is a little bit higher than the first round. So keep that in mind in the calculations. The maximum amount on this loan is $2 million. And here's a big thing, the EIDL advance amount that people got is now not going to reduce your PPP forgiveness. So if many of you remember, there was a $1,000 per employee grant that people received when they applied for the economic injury disaster loan. On the first forgiveness application, whatever grant you received, so if you had 5 employees, you got $5,000, that was going to reduce your forgiveness. That is no longer the case. Now, I do want to point out that there's probably a lot of people who have already applied for forgiveness or are in the process of it. If you have already applied for forgiveness, we're still waiting on guidance from the SVA on whether they're just going to automatically remove that line from the application and they're going to notify you that it's all forgiven. Honestly, I don't know at this point how they're going to handle the loans that have already been approved. So that we're still waiting on a little bit of guidance on.
So Nancy, before you go to the next slide, so if we could revert back to that slide, what I want to make clear over that people understand is this is 25% reduction in a quarter. Any quarter, let's say that for the first quarter you had a 25% or more reduction, and then for the rest of the year you had a great year, and it ends up that your sales in year 2020 end up at whatever 2019 sales were. So you had a low first quarter, but you had a rebound for the rest of the year. Just got that question from a client. I'm telling them, yes, you still qualify because it's a 1-quarter test. So
absolutely,
you could have a 2020 record-breaking year, but if one of those quarters was down 25% from the same quarter in 2019, that company mechanically qualifies for the new PPP loan. And a second thing you have on here is that you have used the full amount of the first PPP loan. You actually don't even have to have a first PPP loan to qualify for the second PPP loan. So that first PPP loan, let's say you declined or forgot or just didn't take the first PPP loan, that doesn't mean you're disqualified for getting a second PPP loan, or let's call it a new PPP loan, a first-time PPP loan under these new rules.
Yeah, good point, Eric. And the other thing is, a lot of banks were taking first-time recipients of the loans first. So they started opening up the application process first to small community banks and first-time recipients. And then they're going to be opening it up to other banks and second-time recipients. Some banks may have already done so, but if not, any day. So good point. Thank you for clarifying that, Eric.
And then on the loan amount, which is the second bullet point down, knowing that you can use 2019 payroll or 2020 payroll, 2019 payroll you used on the first round of your PPP. So you did expect the loan to be at least, if you qualify, you'd expect the loan to be at least the same, if not more, than what you had for the first go round for the PPP. So your second draw loan should be at least as much as what your first go round loan was, if you figured your first go round loan correctly.
And that seems to be the big if in the scenario, is that in the first round, because they were changing the rules so often, I have seen quite a few people where maybe they got a little bit more than they were entitled to the first round. So once all the rules were clarified, maybe they didn't receive 100% forgiveness just because they got a little bit too much. So assuming those first numbers were correct, you should actually see a little bit more if you offer life and disability to your employees and dental.
I'm done interrupting you now.
That's quite all right. Again, we kind of just talked about this, but expansion, everything else remains the same. So you're still going to get your payroll, your mortgage interest, rent, utilities. Now, one thing to point out on this is if you are paying rent to a related party, the rent is limited to your mortgage on the property, the mortgage interest on the property that you're paying to the related party. So just want to clarify that. We can help anyone calculate that because I know it gets a little bit confusing. So in addition, they also expanded into a couple other categories. So they included operation expenditures. They included property damage costs, supplier costs, and covered worker protection. So what are some of these things? So obviously the property damage is if you were in an area where there was any rioting or there was any damage to property in 2020, that's going to be included. Any expenses that you had to incur to protect your workers, if you had to increase some shields, maybe for a drive-through window, and this actually includes installing some air filtration systems in your building, operational expenses, any expenses that you need, and supplier costs to continue your operations. So that's helping you generate that revenue. So they've really increased that. There is still that 60% limit. So 60% has to be payroll costs. And then you can subsidize it with all of these additional. We're going to go back to the status.
Yes. Just so everybody's clear, these expanded expenses they're not part of the 2.5 times to calculate the loan amount. Okay.
Correct. That's just payroll.
Just make sure it's a distinction that this is when you go to make the forgiveness, that's, these are the expenses that you can include in the event that you don't have forgiveness using, a lot of payroll and those types of items.
Correct. And that same $100,000 cap is still included. That was included the first time. So you're going to annualize anyone's wages at $100,000. Now I'm going to jump down here real quick to the covered period because that's going to be important. Your covered period is going to be from 8 to 24 weeks. So you can choose the covered period. So in the first round, you picked 8 weeks or 24 weeks. In this round, you're going to choose the covered period, and it starts from the day that the loan is deposited into your bank. So a little bit different than the first round when you were forced to pick one. This one you're going to choose. So remember, that is going to come into play when you're also figuring your cap in your $100,000 annual cap on annualizing anyone's payroll. So the deadlines for this program, people need to apply by March 31st. So I would suggest getting information ready. Now I want to just talk again, the status of the loan. Did talk about it a minute ago, but just want to bring it up again that some banks have not opened their portals yet. Other banks have. I suggest you check with your bank immediately to see if they're ready. Most of them will be doing them online. And in some cases, there's actually a registration process where the bank is asking you to register. And then once they're able to take applications, then they're going based on who's been registered first. I don't know about what you guys think, Eric and Dan, but I'm not sure they're going to run out of the money as quickly as they did the first time. I think because of these eligibility requirements that they've tightened up a little bit, I'm just not sure, especially considering they still had money left from the first round. So again, I encourage everybody to get your application ready, but I don't think it's imperative that you get it in by, midnight tomorrow. So I think with that, I know we had a lot of information we covered here, but I'm going to turn it over to Eric now to talk about the existing PPP loan and kind of where we're at with some of those updates. So Eric, take it away.
Yeah, thanks, Nancy. I'm gonna bring you back for one more question, but to answer what you said on, will this money run out? There's 280 billion or so available for this second round of PPP, and the first round of PPP used close to 600 billion. Okay, so what you're looking at is there's a little less than half available. However, there are a couple things on the second PPP that make me think it's not going to run out. And that is, number one, there had to be a 25% decline in sales. So that's going to limit the availability of this second round to companies that had that 25% decline. And number two, the loan amount is limited to 2 million, whereas the first go around, the loan amount was limited to 10 million. So there's a much lower cap on it. And by using that much lower cap, I think ultimately that is going to keep all loans total under the 284 billion. So I do not believe this one is going to run out of money anytime soon, if at all. Now, my question for you, Nancy, was we didn't get into this yet, but eventually people will want to apply for forgiveness for this second round. Would you be prepared to give them a 1 minute? What's the application process for the second go around? And will they still have to do this reduction calculation with respect to employees over what referenced period?
Yeah, so Eric, and I know you're going to talk a little bit about this, so I don't want to steal your thunder. But there will be a simplified application coming out for anybody under 150,000 or under for the PPP, where there will be virtually no information that will need to be provided with the application other than the certifications. Other than that, the application is going to be exactly the same as the application for the first round. So obviously we're going to see a little bit of changes because they're going to let us add additional expenses, but the calculations will be the same. So again, I think there's going to be some planning involved on whether people are going to go 10 weeks, 12 weeks, 24 weeks. So it will require some calculations and some monitoring of it. But I do anticipate, just like the first round, that we're going to see a lot of people that are going to get 100% forgiveness. So in a lot of conversations I've had with bankers, I actually talked to someone yesterday who said that they have not had anyone be rejected at all for their application based on what they've requested for round one. So I would expect to see the same thing for round two.
Right. And when you say the same applications, you're anticipating it's the same employee reference periods for the base periods, and that is January 1st through February 28th of 2020, or February 15th to was it June 30th of 2019?
Yeah, I haven't seen that yet, but I would expect it's going to be something very similar to that, correct?
Okay.
If not exactly the same.
Thank you, Nancy. Moving on, we'll talk a little bit about the PPP and taxes. So this has been an interesting saga throughout the year. I'll give you the short answer first, a longer answer, and then a caveat at the end. Okay. So the short answer is a good answer, and that is that the PPP funds, once forgiven, are not taxable income, and the expenditures that the PPP funds were used for are tax deductible. Okay. And even though that's a short answer, that still seems like, why did it take so long to say that? The reason it takes so long to say that is because, and this is for those that have received information throughout the year and may still have questions on why there would even be a question on this. Originally, when these funds were made available within the law that made them available, and that was the CARES Act from March of 2020, there specifically is a provision that the PPP funds, once forgiven, are not taxable income. And so what that means is when these funds would be forgiven, so you get the loan, you get to spend it, and then the amount you received is not taxable income. That seemed like a really good thing. It's essentially free government, non-taxable money. And then sometime in July, August, the IRS came out and let some of the air out of that balloon. And they said, well, yes, the PPP funds are not taxable income. However, the money that you use or the expenditures that you have that you spent the PPP funds on are not deductible either. And so what that means is, as you're using your PPP funds and spending on things like payroll, those payroll amounts aren't deductible for federal purposes now. And so when the IRS said that, they effectively went backward and took these PPP funds are not taxable. They took that out of play because essentially by saying, well, here's some money, but what you spend it on is not deductible, that made it so that the PPP funds were in effect taxable. So the law first said they're not taxable. The IRS came back and said, well, we're not letting your deductions be deductible, which effectively would make the PPP funds taxable. And then in the latest law that was passed in December, those specific expenditures that the PPP funds were used for are now deductible again. Okay, so we have kind of come full circle where the original law says the PPP fund forgiveness is not taxable, to the IRS saying, well, yeah, but your expenditures that you use the funds for are not deductible, to now the end of the year with this new law that passed that says, okay, these expenses are in fact deductible. This is a good answer for those who receive the PPP. This is true for both the first round of the PPP and the second round of the PPP for companies that get the second round. So that's the short answer, the long answer, and now the caveat, which is Wisconsin. Wisconsin just announced on Friday that they're going to still disallow the expenses that the PPP funds were used for. So what does that mean when you're doing your Wisconsin tax return? Well, you've got your federal tax return and the PPP funds are a non-issue, but then you get to Wisconsin and you will have to add back the PPP amounts for the amounts that were forgiven. And Wisconsin's not the only state that's probably going to go this route. I think some others have already announced this as well. So on a state-by-state basis, if your company is operating in more than just Wisconsin, you will have to check the rules of that state and see if they allow or follow federal and allow expenses to be deducted for that, or if they're going to be like Wisconsin and say, no, we're not going to allow you to deduct those expenses.
Eric, just want to add that when it talks about the expenses not being deductible, the expenses are, according to the IRS notice and so forth, the expenses are not deductible in the year in which you believe the note would have been forgiven or is forgivable. So if you waited till 2021 to apply for your forgiveness, but you know you're going to get 100% forgiven, that makes the expenses paid in 2020 not deductible in 2020. So that's another twist to this discussion.
Yeah, thanks, Dan. That's right. Is, what's the timing of when this add back has to occur? And even if you haven't applied for forgiveness yet, but you're going to, and you expect to get forgiveness, so mechanically you meet the test, Wisconsin would argue that you have to not deduct those expenses, and that would have been expenses incurred in 2020 when you spent the money. You're not going to be allowed those expenses on your Wisconsin return. Couple other updates on the forgiveness for, this is for round one. So I'm not talking about what Nancy went through, but this is for round one for the original PPP. There's actually a new form coming out, as if we needed one more, to apply for forgiveness. This new form is for any loan under $150,000, okay? So right now we have three forms out. We have the regular form 3508, which is a very complicated and long form. We have a 3508S, which is a simple form that you can use if your loan was under $50,000. And we also have a 3508 Easy, which can be used if you didn't have a reduction in payroll or personnel. And so this will be a fourth application form to get forgiveness, and this is for under 150,000. This will be the easiest form of all. It is really going to be in a test function, which is really, you're going to sign a statement that says, hey, I used the money for what it should be used for, and this is what my loan amount was, and you get forgiven. So this form, we believe, is going to be a very straightforward form. If you have not yet applied for forgiveness for your PPP loan, and the PPP loan is 150,000, you might want to wait for this form. It's expected out before the end of this month. So you'll have a simplified form you can fill out for it. It'd be the easiest one you can do. What also came out, this is for loans on the other side that are over 2 million. As part of the SBA guidance, the SBA announced, hey, we're going to audit people that have more than a $2 million loan. And when the SBA says they're going to audit people, we don't really know what that means, because the SBA doesn't have an audit procedure. They don't do audits per se. So what exactly are they going to do? We don't know, but what we do know is they've issued a loan necessity questionnaire. That's that form 3509. So this is for people just with loans over $2 million. If you don't have a loan over 2 million, you do not have to complete this form. If your loan is over 2 million, you will have to complete this form. It's not part of your forgiveness application, but the bank is going to ask for it after you turn your forgiveness application in. And this form, this necessity form, is essentially gathering evidence or gathering information on what happened with your business in COVID and what kind of liquidity did you have when you asked to take this loan out. And it asks a lot of backwards looking questions. So if you go back to when the loan would have first been applied for, you're attesting to current economic conditions, and you need it because of the uncertainty that you have facing those economic conditions. Now, what this form does is it's gathering backward looking data. What were your sales from March 1st when you got the loan to September 30th? And they're asking different questions of that nature that you wouldn't have known when you took this loan out, but now, because the time has passed, you do know. So we don't know, does that mean that the SBA is now going to take a backward looking lens and say, did you qualify for this loan or not? The good news on this is that within this past law that was just passed, is that the SBA is required to put forward their procedures and policies on how they're going to do these loans. So we should find out by about mid-February, the SBA's procedures and policies on how they're going to pick the loans that they're going to audit, and then how they are going to audit them. Our concern is we don't want, rogue SBA agents out there making their own judgment calls on necessity, using a form that's backward looking, because necessity was really measured at the time when you applied for the loan, not after all these things have happened. And we don't want the SBA misinterpreting what the rules are and saying that somehow there's backward looking tests that apply. We don't believe that's the case.
So Eric, I want to point out too, because it might be a good time to bring this up, that is, if there's any client that their first PPP is under review, they will not be assigned or accepted for a second PPP until the first loan is resolved by the SBA. So whether you were a client that was over 2 million, or even if it was someone that there was some question on the form, the forgiveness application, and you are under 2 million, if it's under review by the SBA, they will not assign a loan number for the second round until the first round is resolved with the SBA. So I just wanted to point that out in case anyone falls into that time period.
Thanks, Nancy, and that makes sense, that they're not going to issue that second loan until the first one is resolved. And the last thing I wanted to cover is the SBA has issued guidance regarding a change of control transaction. So if there's an outstanding loan, whether it be this first one or if there's going to be a second round draw, these change of control rules apply. And it's really, there has to be permission from the SBA to get this change of control or approval from the SBA. So if you're selling your business and you have a PPP loan out there that is not yet completed, either you haven't spent the money or you haven't finished the application for the forgiveness, then you have to notify the SBA and get approval for a change of control or approval for a sale. So that's what I wanted to go over. I will now turn this over to Dan, who's going to talk about some employer retention credits and essentially another place for government money.
Great, thanks, Eric. So we want to leave some time for questions. So I'm going to try to go through this in like 10 minutes or less. But it's really important things that we believe all businesses should be aware of, because we do see potentially some opportunities, especially for businesses that have some reduction in their revenue and also or maybe be forced to shut down as a result of government requirements and so forth. So the first one I want to start with here is the employee retention credit. And I have 2020 opportunities listed on top, but there's also a 2021 opportunity as well, which I'll go in next. But we got to be careful to distinguish the two, because the rules are slightly different for them. And there's the twist to this is that historically, if you applied for the employee retention credit, you weren't eligible for the PPP loan forgiveness. So in the last bill signed, that was removed. And then the employee retention credit for 2021 was also created. So just to quickly go through some of the eligibilities for the 2020, and again, this is a backward-looking situation, so we're looking at potentially having to amend returns or amend 941s or drop a lot of more activity into your fourth quarter 2020. But we're looking at FTEs, and you need to have fewer than 100 for 2020. And if you have fewer than 100 for 2020, then you are able to take all wages for eligible employees. And there's some exception for related parties, but basically if you have, brothers, sisters, children working in the entity, they're not eligible for the retention credit if you're a greater than 50% owner and you're related to those individuals. If I have more than 100 employees, I'm still eligible for the retention credit, but I can only get, the only eligible wages are those for wages that I paid people not to do work. So I paid somebody to be at home, paid somebody in furlough, those types of things might give us an opportunity for that. The business status for you to be eligible for the retention credit is you have to be fully or partially shut down. And there is a bunch of frequently asked questions on the IRS website as far as who's partially shut down. And it's really a facts and circumstances situation, but that is one thing that we can drill into and dig up. The other option is if you have a greater than 50% reduction in a quarter, then you're eligible for the employee retention credit for that quarter and every quarter thereafter until you reach the 80% revenue of the prior quarter, meaning 2019's quarter. At that point, you still get the retention credit for that quarter, but then the following quarter you would not be able to. So for example, if I was at a 50% reduction in the second quarter and 80% in the third quarter of revenue, I would still be eligible for the second and third quarter, but the fourth quarter I would not be eligible for 2020. So we talked about eligible wages, and eligible wages includes your regular compensation that you're paying your employee and the health and the cost of their health insurance. So we got to make sure we don't lose sight of that health insurance, because it's an easy element. Like payroll companies and so forth wouldn't necessarily have that information available. So it's something that requires some additional attention. And the employer, the offset on this is the employer share of the Social Security taxes. So it's not like if you have a bunch of retention credits that you're not going to owe any employment taxes. The reality of it is you only get to offset the Social Security taxes. And the credit calculation is 50% of eligible wages and a maximum of $5,000 for 2020 in aggregate. So you don't get to, if I have $5,000 in quarter two and I have $5,000 in quarter three, I only get the $5,000 from quarter two. I'm capped out. And the forms that we're using to get this refund or the credit application is using your 941. And if you've used up the 941, the current period, you have the ability to file a refund claim back at forms 7200. It was initially thought that it would take like 2 weeks to get your credit as a result of filing that application or form, but it's proven to have taken much longer as a result of the government. So that's really 2020 in a nutshell. And now let's switch gears to 2021, where we believe maybe there's more opportunities for businesses. And again, we have the eligibility to participate in the retention credit for 2021, even if we're going for the PPP loan and the forgiveness. We're looking at the employee count, full-time equivalent employees. In this case, it's 500 or fewer employees. So now, if I had 500 or fewer employees, it doesn't matter whether that I'm paying somebody to do work or whether I'm paying somebody to stay home. All those eligible employees would then be available for a credit opportunity or calculation. If I have more than 500 employees, I still qualify for the retention credit, but I can only get the retention credit on the wages paid for people that are working, that I'm paying for not to come to work. So that's really the, an opportunity there. And from a status of the business perspective, again, we still have the fully or partially shut down due to the government mandates. The criteria is 25% or greater reduction in a quarter compared to 2019. So if I see my first quarter of 2021 is below my first quarter of 2019 by greater than 25%, I'm eligible for for a credit on all employees below 500. If that's the case, or anybody that's above 500 in employee count, then it's only the ones that are not working. But I'm eligible for that quarter. And then if I go to quarter two, I do the same math. And if I continue to have that 25% reduction compared to 2019, I'm then eligible for this credit opportunity again. And again, it's only the employer share of the Social Security taxes. So again, it's not everything, but it's still a benefit. And then it's 70% of eligible wages for 2021, maximum of $7,000 per quarter. So $7,000 per quarter versus $5,000 in aggregate, which was 2020's numbers. Again, a much larger number. And to the extent that businesses can use it, we see it as an opportunity to get access to cash to help the business continue on. Again, we're going to make those adjustments through the 941. Wouldn't expect that you need the 7,200 in these cases because of the ability to know as you're going along. But if some cases you do, then you can utilize that form for that adjustment. So we'll take and let's move on to the next opportunity for credit. It's kind of a refresher. So we have the work opportunity or the employee retention credit, which we just talked about. And then we have the employee sick pay leave credit. Now this relates to the original CARES Act. And so a lot of this should seem familiar to everybody. As part of the CARES Act, the employers had an obligation to pay sick or family leave as a result of COVID, that expired December 31st. So right now, the employers are no longer obligated to pay that additional sick pay, but the credit opportunity was extended until March 31st of 2021. So you have the 2020 year that if you were to pay an employee that was not able to work due to COVID, you could either have a max of $511 per day for an 80-hour work week, or not work week, but 80 hour of work. Or if somebody is, not if somebody is not able to work because they're taking care of a family member or childcare is not available, that type of thing, we get 2/3 of their pay, a maximum of $200 per day. So that is, that credit's the same as we've talked about in the past, but it's been extended to March 31st. So it applies really for the first quarter of 2021. And it's also eligible for self-employed individuals. So where you would take that credit would be on your individual tax return, but know that you should be available and you should be telling your tax preparer if you need to get credit for that activity. From an eligible wage perspective, we're talking about wages paid to the employee. It also includes health insurance benefits paid on behalf of the employee. Again, very similar to the retention credit. A lot of these things are the same. They're on the same form, the 941 and the 7200. But again, the credit can only be taken, the retention credit and the sick pay credit are two different credits of which we're dealing with. And again, you can apply for the PPP loan and still take this credit. There's no exception from that perspective. So then I just want to share a few more things legislatively. We have the deductions of meals and entertainment. Our meals are now 100% for 2021 and 2022. As a result, businesses in the past that had payments at rent, at restaurants and so forth would be eligible for only 50% deductibility. For these next 2 years, we're looking at 100% deductibility. The work opportunity credit was also extended to 2025. Again, if your business isn't looking at this, you want to make sure that you do. It's for hiring targeted groups of employees, and the credit can range from $1,200 to $9,600 per employee. So it's really another credit opportunities. But what I do want to now drive into is when these credits collide. And the reality of it is we talked about the employee retention credit, the sick pay credit, the PPP loan forgiveness, and the work opportunity credit. All three of these credits are really based on, or credits or deductions are based on the use of wages and qualifying wages. And as a result of that, the government has taken and provided guidance as far as when they, where they can be used and what some of the ordering is on their eligibility to be used. So the next slide is going to show about the results, and we'll start with the first, the sick pay and the family leave. From that perspective, the wages can only be used once for this credit. So if you are taking sick pay credit and for an employee, whatever you use for that sick pay is not eligible and should not be included in your PPP loan forgiveness amount. So be prepared or collect your data accordingly. For a work opportunity credit, wages that are used for this can only be used for this credit. And so if you take the work opportunity credit for those wages, you're not able to then include that for some of the other credits, for more so the retention, employee retention credit. So under the employee retention credit, it's all wages, but then we exclude the sick pay and the work opportunity. And but we're in that case, yeah. So those are the two there. The next one is the PPP loan. It must exclude the sick pay leave wages and the employee retention credit wages, but it may include the work opportunity credit. So if I qualify the work opportunity credit, I still can use those wages for the loan forgiveness. There is no restriction from that perspective. So it's really just trying to balance all these things. There is some ordering rules. The ordering rules require that if you that the employee retention credit wages count first towards that, and then the PPP loan. So you can't reposition things as you desire. There is a guidance or mechanism on ordering these credit or wage qualifications.
Hey, Dan,
That's
can
all I
I
have.
interrupt you and give you a couple of things? The results that you have here, you know, I think the point is this is pretty complicated. You're going to want to work through this with your advisor on which credits to use and what order they go in, because it is a fairly complex calculation for these. But I'd actually like to go back a couple of slides here, if you can, Dan. I want to have a question on one of the things you had up. And one more slide. Okay, and then go, I'm sorry, go forward one slide. It's the 2021 employer retention credit. So I think we do have a typo on here. We say 25% or greater reduction in quarterly revenue compared to 2019. It's actually a 20% or greater reduction. So I want to make sure that we, you know, if you're following along with us and wrote 25% down, it's really 20%. So if you have a 20% reduction in sales from 2019 Q1 to 2021 Q1, so we're looking at, you know, you got to skip a year and look at 2021 versus 2019, or 2019 Q2 and 2021 Q2, a 20% reduction in sales. That's where these credits are available. And when you're talking about a $7,000 per quarter for credit, talking about $7,000 per employee credit. So the credits can actually get quite large.
Correct. Yeah. And thanks for correcting that. Yes, typo. But, you know, we're going to get some large credits here. Whether you're able to use them all will be, you know, another piece of this, and, you know, how it impacts your loan forgiveness application. What we're seeing is with the 24 weeks, the PPP loan forgiveness, you should have the ability to take both. But with this fairly significant credit amount of $7,000, you might put yourself in a position where you're not either able to grab their employee retention credit, because you can't, if you take their employee retention credit, anything you, all the wages and so forth that qualify for the retention credit have to get excluded from the PPP loan forgiveness calculation. So that might create, you know, it's $10,000 per employee that you ultimately end up excluding, and it could create a problem. So it's one that's going to require some analysis as far as what credits benefit you and what do you leave on the table by selecting one credit over another.
And we'll figure that out for you. I mean, that when it comes down to it, that's what we'd figure out for those that are applying for PPP and also qualify for these credits, is how do you do this and make sure that you're not leaving money on the table? And that's where we come in.
All right, so Nancy, Dan, and Eric, yet again, here we are with 10 minutes to go. We thought we'd have plenty of time for Q&A, and we do still have a few. I want to just let everybody know that, number one, you will get an email with the link to the recording of this. So yes, those of you taking notes, you can go back, you can rewatch. And then we also have some printed or written PDF of material that I'll tell you about here in a couple minutes. But let's dive into, we've gotten just a ton of questions. I know you guys have tried to answer some of them via the chat function, but I'm going to start with a couple of more general questions that have come through. So somebody asked if you could just discuss the pros and cons to each coverage period, the 8 or the 24 weeks.
Yeah, so I think that is actually a pretty easy conversation, because if there were any reductions in any FTEs or anything, you're reducing it on the spend, you are not reducing it on the loan. So for example, if you had a loan of $100,000, but you spent $200,000 in payroll over a course of 24 weeks, even if you had a reduction in FTEs, that reduction would have to be 50% to get you to that $100,000 loan. So I think the moral of the story is the longer the covered period you use, the more expenses that you've incurred, the more qualified expenses. So if there were any reductions for any reason, more than likely the reductions would still not reduce beyond the amount of your loan. So hopefully I explained that. So again, any reductions are based on the spend and not the amount of the loan. So extending it out a longer time period gives you the maximum opportunity to have the maximum amount of forgiveness because you're spending more money in a 24-week period.
Yeah, Nancy, I think I'd add to that, that of all the applications we've seen for forgiveness, at least 90% of them, maybe 95% of them are using the 24-week covered period, and they're getting maximum forgiveness.
Right. My recommendation to people my recommendation had been in round one, do not apply for forgiveness until you have spent at least 150% of your loan. Because then again, you have some flexibility if there were any reductions. Honestly, the only reduction that I have seen in any application we've processed is the case where someone actually received more than they were entitled to because the rules weren't clarified when they were applying for the loan. Those are the only time that I have not seen 100% forgiven.
Okay, can you go over the exclusions and inclusions for calculating the 25% reduction in revenue?
Yeah, so I guess I'll take this one. This is basically going to be all of your revenue. So it's going to be interest, it's going to be discounts to revenue. What it's not going to be, obviously, are those items like I had talked about before, the proceeds from any loans you got. So if you had an SVA loan and you received that 6 months of funding from the SVA on your loan, that's not going to be included in income, but it's going to be really all sources of income. You know, when you look at a tax return and you've got your line one for your revenue, and then you've got any discounts, it's going to be that amount of revenue. So it is pretty inclusive in what's included in that gross revenue.
And
Nancy, there's another, sorry, Lee, there's another question here related to that. Is the Health and Human Services stimulus payment gross revenue or not? I have not looked at that answer yet. I don't know, but I think that Health and Human Services stimulus payment was something that maybe you had to pay back. So if you didn't spend it or need it for whatever it was supposed to be spent for, are you familiar?
Yeah, that was another one that was based on gross revenue. My gut would tell me that would not be included in revenue if it was forgivable. But honestly, we have seen such little information about that particular loan or maybe grant. I honestly don't have an answer. My gut would tell me that it wouldn't be included, but we probably want to try to dig into that a little bit deeper. It's just not something there's a lot of information on, is that particular loan or grant.
We should
Right,
add,
and I know from
should
speaking
add
with
to
the head of
the-
our, oh, go ahead.
we should add to the revenue element, it's the gross revenue. So for example, if you have capital gains of nature, it's your gross proceeds from that transaction. So be careful on that if you have those extraordinary types of events that are going on within your business. And maybe it helps your 19 number be higher and your 2020 be lower, but it's a gross level that you need to consider as well.
Okay, good. Where does the research and development tax credit sit when you apply for PPP loan forgiveness? Should we still exclude qualified wages included in that tax credit when we apply for forgiveness, or is this no longer an issue?
Yeah, I would say it's no longer an issue. At the time when the IRS released their guidance and said you cannot deduct the PPP funded expenses, there were some who thought, well, that means that if it's not deductible, I can't use those wages for calculations like the R&D credit. Now that those amounts are deductible, I don't think there's any cross up between the R&D credit and the PPP loan forgiveness. You can get PPP loans, loan funds. You can use them for wages. You can include those wages then in your R&D credit calculations.
Okay, let's get into some more specific questions. We did have a handful of questions that came in that were sort of repetitive. We got them 2 or 3 times at least. One of those was looking at, I think PPP round 2 and the quarters. Does it have to be a calendar quarter, or can it be any 3 consecutive months?
It has to be a calendar quarter.
Okay. So, and then there were some questions about confirming the payroll amount. Can you confirm the payroll amount is to include the health, life, and dental for employer costs added to the payroll number times 2.5, or is that an after the multiplication?
So that depends the entity that you are. The question can maybe get a little bit more complicated, but if you're an S corporation, so first of all, there's that $100,000 maximum. If you're an S corporation, any owners of the S corporation, the health insurance is included in that number. For other employees, it is not. So hopefully that simplified it a little bit, but it's for other employees, it's $100,000 plus they can include their health and dental insurance.
And can you explain the $46,154 cap, kind of how that number came to be?
Yeah, I actually typed this in the chat, but I will repeat it. So what that is, that's that $100,000 annualized. So if you divide the 100,000 by 52 weeks, you get like $1,923 per week times a maximum of 24 weeks. So again, this is assuming you're picking a 24-week covered period. That's, you take that amount times 24, and that's where you get the 46.
And you guys talked a little bit about if there was, if the SBA was currently looking at your first PPP loan, but can you verify that a pending PPP loan that has not been forgiven does not qualify you from PPP round 2?
It does not disqualify you. They are looking at the two as completely independent loans. The only thing that would possibly cause an issue is if that first loan is under examination by the SBA, but it doesn't automatically disqualify you. It just, they're not going to accept or provide a loan number on the second round. But they are two totally separate loans. So it should have no impact on you applying for a second loan.
Right. So if you're PPP, you haven't even applied for, let's say, forgiveness yet, but you expect to get forgiveness, you can still apply for that second loan right now.
Absolutely. And we actually have quite a few clients that we're recommending hold off on the forgiveness on the first round because they were under 150,000. And we are actually waiting for that simplified form so we don't have to gather all the information. So we're telling people, let's wait till that form is out to apply for forgiveness. But in the meantime, get your application in for round 2.
And another question that came in several times, there's a lot of talk about that $2 million mark. A lot of questions coming in about, is that a combined, is that being looked at as a combined number, or is that each PPP loan?
That's each PPP loan, right? So the first loan is really a $10 million cap on the loan. The second loan is a $2 million cap on the loan, but that's on the second loan itself, that $2 million. So if your first round PPP loan was 1.5 million and your second round PPP loan is 1.5 million, you'll get 3 million in loans if you if all other things qualify. You're not limited on that second PPP loan because it's not a combined amount. It's just for the second loan where the 2 million cap kicks in.
Okay, I feel like we could probably go another hour, hour and a half if we just kept taking questions. I know there have been a lot of very specific questions put in. Please reach out to either your SVA contact or to any of our presenters, and we can get those questions answered for you. As we wrap up here, and we want to be respectful of everybody's time, I do want to let you know that you can visit svaaccountants.com/hub, where the recording of this webinar will be available, as well as our PDF overview on this most recent bill. Our next webinar is on January 27th, and that's going to be on streamlining your accounting software. We then have some industry-specific roundtables coming up over the next few weeks. We are limiting attendance to those because they're going to be very interactive. So you're going to have your video on, you're going to have a chance to ask a lot of questions about PPP loans, but also just about what's going on in your industry and looking forward. So I just want to let everybody know, if you do have an interest in those, please sign up quickly. We are limiting that attendance, and I know they're getting pretty close to full. So please try to sign up this week if you can. And I just want to remind you all that the SVA team is only an email or a phone call or a Zoom meeting, whatever it is, away. So if you're a client, reach out to your SVA contact. And if you're not currently an SVA client, please reach out to me and I can get you the help or the questions or the answers to the questions that you need. So please have a great rest of your day, and we hope to see you at some or all of our upcoming events. Thanks again for coming and for joining us today, and be well.
Bye.
Goodbye.